Good morning, everyone. Welcome to our Regional Economic Conditions webinar. My name is Carmiana Matson. I am the Assistant Vice President of Regional Outreach and Public Programs at the Minneapolis Fed. Today, we'll be hearing from Ron Wirtz, one of our Regional Outreach Directors. Ron's slides and a video of this presentation will be emailed to you sometime next week, so you'll be able to have that for future reference. We will, at the end of the presentation, have about 5 minutes or so for questions. So if during the course of Ron's presentation you have some questions, please locate the chat box located at the bottom of your Zoom screen, and you can type questions there that I will pose to Ron. Also, when you exit the webinar, you should be presented with a feedback survey at the end. We'd appreciate getting your feedback on our webinar series. Some of you may have attended these before, so we appreciate hearing your feedback. And with that, I will turn it over to Ron.
Good morning, Carmi, and good morning to everyone joining this morning. I really want to take just a second to say thanks to everyone who is interested in this topic and is joining us. For those that have joined before, you'll see some similarities in this, but for those that have that this is a first time for this webinar series, I'll give you a little background on why we're doing this. Before I get started, let me reduce that, and I need you to there we go. Give you my disclaimer that the views that I express here are mine and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. So what we're doing today is what we're calling our Regional Economic Conditions Update. It's a new webinar series from the Minneapolis Fed. So why are we doing this? This is really an extension of an annual Regional Economic Conditions Conference that we host in January every year, including this coming up January. And that conference is really designed to connect people and research that's related to the 9th District economy. The pandemic has really encouraged us and really forced us to do more survey work and to be gathering other data and intel to get a better idea of what's happening during this pandemic, because things are happening at happening much more quickly. And so this webinar series is really designed to be better outreach for the bank in order to connect with businesses, community leaders, policymakers, and the public in general to discuss what current economic conditions are in the 9th District, because the pandemic has seen such volatile change in our economy. So the survey that I'm going to talk about today is done through a network of partners. And I want to take a quick second to thank partners, especially any that might be on this call this morning. I have about 35 partnering organizations across the 9th District that essentially get our survey out to businesses. Mostly there are a lot of chambers of commerce, economic development organizations, government agencies, and others. Excuse me, a little quick there. This is the 5th business survey since we've started, since the start of the pandemic, and this survey now is being conducted quarterly. So why are we doing this pandemic outreach in terms of surveys? The speed of the pandemic really has created a need for more and better real-time information for the Federal Reserve System and the Minneapolis Fed. How are we filling that gap? We've really decided, because a lot of government data that we typically have depended on really is time lagged. So we decided that we needed to go out there and really reach out to businesses directly. And so we're doing a lot more outreach since the start of the pandemic. We've done 12 of these of this survey, as well as some other construction and some other surveys since mid-March. In all, we've reached almost 10,000 businesses. And equally important, not only are we getting their responses to multiple choice questions, they are giving us an inordinate amount of open commentary about how the pandemic is affecting their businesses. That really gives us a very granular feel on how things are, on how firms are being affected during this pandemic. And I should mention too, for anyone that's out there that is a respondent to our surveys, I should have said thanks to you as well, because you're providing us with really valuable information. Today's focus is going to be on our general business survey. Again, we've done this survey 5 times. The most recent one we conducted in early October 5th through the 12th. We had roughly 600 responses from Minnesota, the Upper Peninsula, Michigan, and Wisconsin and South Dakota. North Dakota and Montana, we did not see a high enough response to include them in this particular webinar. I want to let everyone know that in terms of how to read these survey results, these are a snapshot. This was not a scientifically sampled survey because of how we reached businesses. This would be considered something closer to a convenience sample. So I just want to caution everybody to not overinterpret some of the results that you're going to hear and see today. So the first thing I want to talk, and I'll spend several slides talking about recent sales and revenue performance. Really, that's the lifeblood of businesses. So I'm going to spend a fair amount of time talking about recent sales and revenue. So the thing we asked, kind of the base question that we asked businesses is that we wanted them to compare recent third quarter revenue, July, August, and September, to 3 different time periods. We wanted them to compare it to the same period last year, the previous quarter, so quarter 2, April, May, June, to the most recent quarter. And then we wanted to get some idea of what they expected for the fourth quarter. And generally speaking, not surprisingly, revenues were significantly worse than last year, the same period. I would say they were modestly better compared with the previous quarter, but still they are net negative. If you look at the red being a negative revenue outcome versus the green, you're still seeing a net negative outcome in the most compared to the second quarter. And for the upcoming fourth quarter, we're also seeing a lot of caution and a negative outlook for Q4 among our respondents. So now I'm going to break down these results by a couple of different demographic traits that we asked businesses to identify. The first one is by state. And so what I would tell you here is that you are seeing a fair amount of both similarity and some differences here. And I would say geography matters in terms of what we saw with regards to results, but I would say there's some caveats to it. So in general, what I would say, especially compared to some of the earlier results, I would say the Upper Peninsula of Michigan saw slightly better results than we had seen in previous. I think some of that is probably due to a strong summer tourism season up there. There's a lot of tourism businesses up there, and earlier in the pandemic, when a lot of businesses were closed, we saw fairly significant negative results from a lot of businesses up there due to some of the business restrictions that were in place early in the pandemic. So we're seeing a little bit stronger results there. Otherwise, in Minnesota and Wisconsin, we're seeing fairly similar results. South Dakota, among the states, is definitely saw the best results kind of across the board. I would only caution that I think there's some response composition that's in play here, in that we had a smaller survey response from South Dakota businesses, and they were underrepresented among sole proprietors and overrepresented among large firms and those sectors that were less impacted, like banking and finance. And that'll make a little bit more sense when I go to a couple of future slides. So as I mentioned, we asked businesses to identify the sector that they were in. And what we're seeing is that, again, there's very clear impact kind of across all sectors. Not very surprising, because this has been, kind of nationwide and economy wide. But what we're seeing is that there was, what I would point to is some of the middle ones, some of those that were more impacted in the second quarter, in the start of the pandemic: healthcare, accommodation, food, drink, retail. They saw a fairly significant early impact. And so I think you're seeing a little bit more of a bounce back in some of those sectors. What I would point out, though, is that in general, you're seeing, fairly significant percentages that are still seeing revenue decline. And what I would also point out that the chart doesn't show is that more firms are seeing a larger revenue decline compared with those that are seeing a large increase in their revenues. So there would be more dark bars on the red than more dark green bars in terms of the increase, if I were to split that out a little bit in a little bit more detail. Size also matters. This is something that we have seen very consistently through all of our surveys so far, in that firm size really matters in terms of impact. And what I would say is that smaller firms have really seen two things. They are more likely to have seen any revenue decline, and they are more likely to have seen a large revenue decline. So the larger the business, they were less likely to see a decline, and maybe more importantly, is that their declines tended to be smaller. We also asked firms to identify by ownership, so minority-owned, woman-owned, veteran-owned businesses, or none of the above. And the one point here I would make is that we are seeing that minority-owned businesses, in terms of decliners versus growers, roughly for every 2 minority firms that saw a decline in revenue in the third quarter compared to the second quarter, only 1 saw an increase. And if you look down at the very bottom for the none of the above, the white-owned firms. It's almost a 1-to-1, so that for everyone that saw a decline, close to one saw an increase in revenue as well. So we are seeing some disparity there as well. So what about other results? So we asked firms about a number of different other elements about their business and some of the challenges, and I'll be covering those now. And one of the things that we're very interested in, that the Fed is very interested in, that we pay a lot of attention to, is employment and workforce. And what I would say again now, here I'll go back to what kind of the original question was in terms of comparing now to 3 different elements compared to 12 months ago, compared to the end of June, and then what's expected going forward. And so what I would, again, compared to 12 months ago, we're seeing a much more dramatic decline in terms of overall workforce and the number of firms that have had to cut and even make fairly significant cuts in terms of this dark red block here. But they're also net negative compared with June levels. So it's a little bit closer in terms of we are seeing a little bit more firms hire. And we do know that hiring is going on even in the pandemic. Some sectors are tending to rebound a little bit faster, but we are still seeing a fair number of firms, and percentage-wise, a little bit over 20%, that have reduced staff compared with the end of June. And even more notably, going forward, expected by the end of the year, is that we're essentially looking at roughly the same outcome, that it looks like there will be an additional net cuts expected in Q4 in terms of staffing levels. In terms of wages, there's kind of a good news, bad news. The bad news is I think we're seeing that wage cuts have been fairly likely, even across all firm sizes. You have close to about 20% of even the largest firms that instituted some form of wage cut, maybe small, but in some cases not necessarily that small. But as you go down in firm size, we're seeing more dramatic effects, especially in this below fewer than 10 employees and sole proprietors in particular. I don't want to say it's not surprising for sole proprietors, but if revenue is going to be impacted, if they are their own employee, virtually, it's going to be a very direct relationship in terms of lower revenue is going to mean lower income. So we are seeing very dramatic wage impacts on sole proprietors, and less so among employer firms, but still very notable. In terms of what's upcoming, I would say the good news is that we are hearing that firms are going to look like more likely to raise wages with over the next 6 months. Again, a lot of firms make some wage decisions at year end, and it looks like on par, we're going to see at least some modest wage growth going forward. Not for everyone, again, sole proprietors still being in a very precarious position with regards to wage. So we also asked businesses to tell us about current production capacity and customer demand. We're very interested in this idea of not only whether or not business restrictions, how they are impacting businesses, but also whether or not that's affecting the actual ability to meet what demand is actually there. So the left chart is talking about current production capacity. And basically what I want you to focus on are the light red to darker red bars. And basically what this means is that not quite 50%, roughly about 45% of businesses are working at or operating at 75% of capacity or less. So we know that there's a lot of capacity that's not online right now. And that's not really expected to change at all by the end of the year. The interesting thing, though, if you go to the right chart, we're asking them to tell us about customer demand in relation to the firm's operating capacity. And what this says is that roughly 60% of firms, even at reduced capacity, are still seeing demand that is either somewhat or well below current capacity. So in a nutshell, what we're seeing is that customer demand is lagging even restrained capacity right now. So it really is a demand problem that we're seeing, probably more than a business restriction problem. We also asked firms, we know that lagging demand is obviously a problem for businesses. That's a problem number one, without question. I think stronger demand would settle a lot of other problems. But along with lagging demand, we are hearing that firms are struggling on a number of different fronts. So we asked them to pick only one particular challenge in among a universe. We decided to ask about these five, and what you see is that many of them are facing very different um, problems, and if we were to allow if we allowed them to pick more than one, chances are many of them would show that these are all problems for lots of businesses. So we're really seeing a circumstance, whether it be increased expenses related to sanitation or supply chain problems, labor availability issues, and other matters. We already knew, but this is really kind of confirmation that businesses really are under pressure from a number of different areas. We also asked, we're hearing about material shortages and supply chain problems. We're really interested in knowing, obviously the Fed is very interested in inflation. So we asked them about what's happening to input costs and final prices. Excuse me. And what we're seeing is that firms are reporting a pretty notable rise in input costs, and we are starting to see some bleed through to final prices. I would say the one thing I thought maybe might be happening here is that given more pressure on small firms, that we might be seeing a little bit more a little bit more price inflation there, and that doesn't appear to be the case. At least it seems to be fairly balanced among employer firms. We also asked about insolvency, and this is kind of a good news, bad news situation. I would say the bad news is that 1 in 10 firms uh, say they are probably going to be insolvent within 3 months if the current conditions persist. The good news on that is, again, these are snapshots, so they're not technically exactly comparable. But in the July survey, that percentage was 16%. And the May survey was 28%. Again, not surprising, especially the May number, in that we were deep in this pandemic, and if you were to roll forward those conditions, those were extreme. So I think it's reasonable that businesses are starting to feel a little bit of a planing out of circumstance. They kind of know what the environment is. So I think more of them have been able to react within this environment, to try to survive. So we are seeing that metric improve, which I think is good. We do, though, however, hear still about an awful lot of uncertainty about future prospects. So we ask about outlook. And what I would say here is that there is actually some balance, but it's very volatile. Normally, we would see the neutral, or kind of uh, the unsure. We would see a larger percentage of that. Um, and what we're seeing now is very high shares on both sides. And that's good in the sense that we have a fairly high share that are optimistic. We have an equally high share that are pessimistic. So again, what I would say is the pandemic and the recovery itself seems to be fairly uneven, and it really depends on lots of different factors, some of which we've talked about here. Some of the quick takeaways that I would offer to everyone is that we've seen some modest improvement from earlier in the pandemic, but the recent revenue trends are still negative, which I think is very concerning. Small firms, minority-owned firms, and those that are consumer-facing or crowd-based firms seem to be getting hit the hardest still. Staffing levels, employment have been soft, and right now our respondents are telling us that that is likely to continue. Demand is obviously a problem, but businesses are facing lots of other operating challenges, even for those that might be experiencing some increases, things like having to deal with daycare issues, having to deal with additional costs, having to deal with some labor availability issues, and other issues like supply chain problems. We know that there are a lot of challenges out there. Solvency is improving. I don't think we should call that too big of a win, because we know there's still a threat. 1 out of 10 businesses thinking that they can't last for 3 months is still a very big number. And we know that businesses are facing lots of uncertainty and low visibility into 2021. I mentioned all those comments earlier that we get. In reading through some of those comments, that's really where you kind of get the better understanding that firms because they're facing so many challenges and because the pandemic has been so volatile, what they see into 2020 is much harder than usual to predict in terms of their business prospects. So moving forward, we're doing a lot to try to track the COVID economy. We're going to continue some survey work. We are going to be surveying construction firms later in this month. That will be that's also part of our regular series. We also have an ag condition survey that's going to be coming out in November. And we're also doing a lot more gathering of better real-time metrics on economic activity. I want to make a very quick plug. We have a new COVID-19 dashboard. If you just Google COVID-19 9th District dashboard, you should be able to come to this quickly, or to go to minneapolisfed.org, and you should be able to find our dashboard very quickly. We have a number of metrics on there that are much more real time. As you can see, this is from mid-month, in terms of change in seated diners. And then we also have a lot of really good data on current levels of the COVID infection rates and other measures having to do with COVID itself. There are lots of interesting features. You can turn on and off any of these particular states to kind of clean up the chart. There's also other charts that give lots of measures of whether it be retail or recreation that you can kind of toggle between different things to find new results. I would highly recommend it for anyone that hasn't seen it or tried it yet. That's the end of my formal presentation. I think we have probably 5 or so minutes left to take some questions. Carmi, I'm wondering if if anyone has lobbed any questions at you, and we can get started with that portion.
Yes, we've actually had several questions come through in the chat box. You can feel free to continue to submit questions via the chat box at the bottom of your screen. Ron, if you want to scroll back to your early slides about revenue, the first question was from an attendee who was a little surprised that there was an increase in revenue in accommodation, food, and drink, given closures in the hospitality industry.
Right.
So I just want to clarify, you are comparing Q3 with just Q2, correct?
Right. I think that's probably where, and I agree. I think some of these, because the pandemic has been so volatile, comparisons can be very, very tricky. And I think what you're seeing here is that for one, there may be actually fewer or those that responded earlier may be out of business. So there may be actually some sample bias here in terms of those that are responding later are the ones that are still in business. And if they are in business, the comparison that they are using, that we're offering here, is compare it to the period that was the worst in the pandemic for accommodation. Many of them saw really low occupancy rates. So while they're still low, I wouldn't, again, all we're doing is asking whether or not your revenue increased. We didn't say whether or not everything was back to normal. I think you'd see a very different response if that were the question. So admittedly, these comparisons have a lot of nuance to them. I think that was a great question and a great point to make, in that, again, we're comparing revenue from for some businesses when it was really probably quite low, and comparing, okay, did your revenue grow in the most recent quarter? So I think that's some of what's happening in this particular slide.
Great, thank you. A questioner is wondering if we have any data on impact due to social unrest in the Twin Cities contributing to any statistics.
We don't exactly. What I would say is I'm gonna go back to our COVID dashboard. We are trying to pay a lot more attention to real-time consumer data. And so what I would point to as maybe some evidence of what's happening in Minneapolis, again, probably due to a lot of factors. It's a more dense area. We are seeing a little bit more in social unrest. So I think there would be a lot of factors to unpack. But if you take a look at the chart on the left, so change in seated diners at restaurants, we do have a measure for this is Minneapolis, St. Paul. And I believe the red bar here is that. And what you see is that we are seeing it be lower than the other comparables, the state of Minnesota in general, Wisconsin, and the US. So we are seeing some measures that consumer behavior might be a little different than what we might otherwise expect to see in relation to Minnesota. Very typically, what you see in Minneapolis is what you see in Minnesota, because it's such a large part of the state. But you do see, for example, in this chart, that some of that behavior for Minneapolis is different than the overall state average.
Great. There were a couple of questions in the chat asking about labor availability. A little surprising for some to see that businesses are indicating that's still a challenge when so many people are unemployed. Could you
Right.
speak a little bit about that?
Well, that is a very difficult issue, and it's been tough for us to kind of get our hands around that. We know that the economy is recovering more quickly for some sectors, and I talked to a lot of staffing firms as well, and we are hearing about increasing labor availability, difficulty in finding labor. And given that there are a lot of unemployed, there is this dynamic going on. We've heard different reports. It's really hard to know exactly what's happening. For one, you have mismatches. So just because a person's been laid off doesn't mean that they're automatically going to be qualified for the opening that's available. We do know that with regards to, at least in the past, the fairly recent past, there have been enhanced unemployment benefits, and the effect to which some of that might be having some influence on labor availability. We're still really kind of looking at the data and trying to tease out where that's having an impact and where it isn't. But we are hearing about kind of a very lumpy kind of labor market right now, where on one side you have high unemployment, but we are hearing about increased labor lack of availability.
You had mentioned earlier some of the data being skewed by the fact that some businesses have in fact closed since you've last surveyed. And a questioner was asking specifically about your insolvency slide and whether we think the declining expectation of insolvency is being impacted by firms that have already closed.
It's hard for me to know exactly. I would say that probably is part of it. I'd be a little surprised if it were a large part, for two reasons. For one, I think businesses are really good at adapting. Many businesses are. So I do think the simple function of time has allowed businesses to find some footing in order to stay viable. I would say there is probably some impact in terms of the number of businesses that have responded to previous and not done it in the most recent one because they went out of business. But because we're going through partners, chambers of commerce, things like that, I don't think, I have a feeling those that are connected to those kinds of organizations are likely to still have been in business. Again, that's an estimation on my part. So I think it's safe to say there's probably some influence there. I would probably consider it to be pretty small.
We have a questioner who is wondering if we're getting to a point where we need to put more emphasis on preserving what's left of the economy versus stopping the pandemic, given that the economy is near collapse in many places and the rate has slowed in many areas of the country. Do we need to focus more on reopening and less on the pandemic?
Right. The only thing I would say on that, I'm going to fall back on my president, Neil Kashkari. I think he has made a very strong case that right now you can't separate the two, because as some of the data that we're looking at seem to suggest is that, for the most part, the economy is driven by consumers. 2/3 of our U.S. economy is driven by consumer spending, and what we're seeing is an increasing relationship between the pandemic and the spread of the virus itself, and how willing people are to be out and about and to kind of return to their normal economic lives. So we don't think you can decouple the two. Now, there may be better approaches in terms of how you manage the virus, the precautions that you take while still being able to be your normal economic self. I think that's something that we're struggling with right now, and that I think I hope that policymakers are taking a closer look at it, how to do that. But I don't think we can just say we're going to open up the economy and everything will return back to normal. Some of the ad hoc surveying that I'm doing suggests that even if you were to do that, take off all the restrictions, it doesn't appear that consumers would simply go back to their formal economic lives. They are paying attention to the virus. And so I think we have to be able to try to manage both at the same time. Very, very difficult problem.
All right, we're going to have time for two last questions that I see here in the chat. One is actually a question several folks have asked. Do we think that uncertainty about the upcoming election is factoring into any of these statistics?
Very hard to say. I do read a lot of comments, and what I would say is, there certainly is some commentary in a lot of the open comments about the election. I would say there seems to be some balance. I didn't do any analysis. If this is more anecdotal in terms of reading, it seems to me that there is some let's say there's a lot of attention being paid by businesses. What exactly happens afterwards? That's something that we're going to be following very closely.
And our last question, an interesting one about startup companies who maybe have started up recently during the pandemic. How do you track that, given that they don't have demand history or revenue data history to draw from?
No, unfortunately, we don't. And I think that's a really good point. I think the one thing I would say is that the volatility of the pandemic has, I think, created some opportunity for entrepreneurism because, when things change, that's where new ideas come to the fore, new business models, things like that. So I do think there might be some opportunity for entrepreneurialism. In some cases, with more people laid off, there's probably going to be some burst of entrepreneurialism just for the sake of having to find some income. So I do think there might be some of that. Unfortunately, our data systems to track entrepreneurship aren't very good. And they're very time lagged. So that's something potentially through some of the new measures we have, whether it be things like Yelp or other kinds of new data systems, apps, things like that, that we're hoping to get better insights into that entrepreneurship.
Thanks, Ron. Thanks, everyone, for being with us today. Before you close out of this webinar, we'd appreciate you filling out our survey to give us some feedback for future webinars. You will receive an email with Ron's slides and video next week. You will also receive information about any upcoming webinars we have, including the Regional Economic Conditions Conference that Ron mentioned earlier that will be held in January and will feature regional economists from all 6 of the 9th District states, as well as perhaps a fun presentation coming up in December on Alexander Hamilton's role in central banking. For those of you who've perhaps managed to catch the Hamilton musical on your streaming service, we'll be doing some fun things like that as well. So we hope you'll stay connected with us. Thanks for being here. Have a great day.